What if I told you that the greatest threat to your financial future is not a market crash, not a government shutdown, and not even a headline screaming about default, but something far quieter, far more patient, and far more dangerous? The United States now carries over $35 trillion in national debt, a number so large it almost feels imaginary, like a figure pulled from a science fiction novel rather than a balance sheet. Most people hear that number and either panic or tune out, believing it is too massive to understand or too distant to affect their daily lives. But here's the truth that few are willing to confront. When debt reaches historic levels, the consequences do not disappear. They simply shift. And when they shift, they often land on the shoulders of ordinary citizens who worked hard, saved consistently, and trusted that discipline alone would protect their future. The real danger is not a dramatic collapse. It is the slow erosion of purchasing power, the gradual dilution of currency, the invisible tax of inflation that quietly reshapes the value of every dollar you hold. History shows that governments rarely eliminate overwhelming debt by cutting it away overnight. Instead, they manage it through policy, through interest rates, through expanding the money supply, through mechanisms that seem technical and distant, but ripple into every savings account and retirement fund in the country. This is not a conspiracy, and it is not chaos. It is strategy, it is economics, and it is a reality that demands awareness rather than fear. When inflation rises, your paycheck may increase, your portfolio may grow in numbers, and your assets may appear stronger on paper, yet the real question becomes deeper and more unsettling. What can those dollars actually buy? If the value of currency declines steadily over time, then stability becomes an illusion. This is why thoughtful investors pay attention not only to returns, but to purchasing power. It is why leaders in finance emphasize resilience over reaction. Abigail Johnson has often highlighted the importance of long-term thinking, of understanding macroeconomic forces rather than chasing short-term noise. Her perspective reflects a philosophy rooted in preparation, discipline, and strategic patience. The lesson is not to panic at headlines or obsess over daily fluctuations. The lesson is to recognize patterns. When governments carry enormous debt, they possess powerful tools to manage it, and those tools influence inflation, liquidity, and interest rates. The average person may not sit in policy meetings or analyze central bank balance sheets, but the impact still reaches their retirement plans, mortgages, and savings. And here lies the uncomfortable tension. The system is designed to function, yet it does not guarantee equal outcomes. Those who understand how monetary forces work can position themselves to adapt. Those who ignore them may slowly lose ground without realizing why. Imagine working for decades, contributing to your retirement account faithfully, only to discover that the cost of living has quietly outpaced your growth. Imagine believing that the number in your account represents security, only to find that inflation has reshaped its true value. This is not meant to create fear. It is meant to spark clarity, because clarity leads to action, and action creates strength. The conversation about $35 trillion should not end with outrage or denial. It should begin with education. It should inspire individuals to ask deeper questions about asset allocation, diversification, and long-term resilience. It should encourage families to think beyond nominal returns and consider real returns after inflation. The truth is that economic cycles are not new. Nations have faced debt before. Markets have adjusted before, currencies have evolved before, but every generation faces its own test of awareness. Ours is not about whether the country will refuse to pay its bills. It is about how the burden of those bills is distributed over time. It is about recognizing that inflation can act as a silent redistributor, slowly shifting value from savers to borrowers, from fixed incomes to flexible assets. And once you see that pattern, you cannot unsee it. You begin to realize that protecting your future requires more than optimism. It requires strategy. It requires understanding how policy decisions ripple through markets and into your daily life. It requires refusing to be passive in a world that rewards preparation. The number 35 trillion may seem abstract, but its implications are deeply personal. Every dollar you earn represents time, energy, and sacrifice. Allowing that value to erode without awareness is not inevitable. It is preventable. And the first step toward prevention is understanding the game being played, not with fear, but with informed determination. But here is where the story becomes even more unsettling, because once you understand that inflation can quietly reduce the weight of national debt, you must confront the deeper question of who absorbs that reduction. Debt does not vanish into thin air. It is transformed, reshaped, and redistributed through time. When a government expands the money supply or holds interest rates below the natural pace of growth, the real value of what it owes slowly shrinks. On paper, obligations remain the same, yet in practical terms, they become easier to manage because each dollar repaid carries slightly less purchasing power than when it was borrowed. This is not dramatic enough to dominate daily headlines, yet it is powerful enough to redefine generational wealth. The suspense lies not in a sudden collapse, but in the slow realization that the system is operating exactly as designed. The danger is not chaos, it is gradual adjustment. And gradual adjustments are difficult to feel in the moment. You do not wake up one morning to discover that your retirement savings have been cut in half. Instead, you notice that groceries cost more, housing costs more, healthcare costs more, and your fixed income stretches just a little less than it used to. Over years, that subtle pressure compounds, and what once felt secure begins to feel uncertain. This is where awareness separates anxiety from strategy. When you understand that inflation can act as a policy tool, you begin to see why protecting purchasing power must become a priority rather than an afterthought. The philosophy often associated with Abigail Johnson emphasizes resilience built through diversification, innovation, and long-term commitment rather than emotional reaction. It is not about predicting every policy decision. It is about building flexibility into your financial life so that you are not overly exposed to any single force. Consider the individual who relies entirely on fixed income instruments during a prolonged period of rising inflation. On the surface, stability seems comforting. Yet if returns fail to outpace the erosion of currency value, stability becomes stagnation. Meanwhile, assets tied to growth, productivity, or tangible value may adjust differently, sometimes rising alongside inflation, sometimes buffering its impact. The suspense deepens when you realize that the choices made today will echo for decades. Every allocation, every decision to save or spend, every assumption about future purchasing power carries weight. And in an environment shaped by historic debt levels, assumptions can be dangerous. The easy path is to ignore complexity and hope that institutions will manage everything flawlessly. The harder, more empowering path is to engage with the reality that policy decisions influence markets and markets influence your life. There is a psychological component to this moment in history that cannot be ignored. Large numbers create numbness. 35 trillion feels abstract, distant, almost fictional. But abstraction fades when you translate it into inflation percentages, into interest rate shifts, into the cost of living over 20 or 30 years. Suddenly, the conversation becomes personal. Suddenly, it becomes about whether your future self will have the same freedom you imagine today. This is where discipline becomes revolutionary. While others react emotionally to headlines, the disciplined individual studies trends, adapts thoughtfully, and maintains a long horizon. Economic environments change, yet principles endure. Productivity creates value, innovation drives growth, ownership of resilient assets can outpace currency erosion over time. None of this eliminates risk, but it transforms blind risk into calculated positioning. The tension intensifies when you recognize that monetary policy is not static. Central banks adjust rates in response to economic pressures. Governments respond to political and social demands. Markets anticipate and react. The landscape shifts, sometimes gradually, sometimes abruptly. In such an environment, complacency is the true threat. It is easy to believe that because the system has functioned for decades, it will always function the same way. Yet history teaches that cycles evolve. Periods of low inflation can give way to higher volatility. Long stretches of stability can transition into recalibration. The question is not whether change will occur, it is whether you will be prepared when it does. Preparation does not mean withdrawing from opportunity or living in fear. It means building financial strength with intention. It means understanding that nominal growth is not enough if real purchasing power declines. It means evaluating whether your strategy aligns with a world where debt management may rely more on inflation than austerity. The suspense reaches its peak when you consider the long-term implications for retirement. Many people plan decades ahead based on projected returns and expected expenses. But projections assume certain inflation rates, certain policy paths, certain stability. When those assumptions shift, plans must adapt. Ignoring this reality does not make it disappear. It simply postpones the reckoning. Yet within this tension lies empowerment, because once you recognize the forces at play, you regain agency. You can seek education. You can diversify intelligently. You can prioritize assets and strategies designed to protect real value rather than just nominal figures. You can refuse to let historic debt levels become an invisible thief of your future. Awareness turns uncertainty into motivation. It transforms fear into focus. And in a world shaped by massive debt and subtle monetary shifts, focus may be the most valuable asset you possess. The final truth is both sobering and empowering, because once you see how the system operates, you realize that the outcome is not predetermined for you unless you choose passivity. Historic debt levels may shape policy. Inflation may influence purchasing power, and currency dilution may quietly redefine value. But your response to these forces remains within your control. This is the moment where responsibility becomes strength. It is easy to blame institutions, politicians, or economic cycles. It is harder, yet far more productive, to ask how you can position yourself intelligently in an environment that rewards preparation. Every era presents its defining financial challenge. For previous generations, it may have been global conflict, oil shocks, or market crashes. For this generation, it may be the long-term consequences of unprecedented national debt and the policies designed to manage it. The difference between those who struggle and those who endure often comes down to awareness combined with disciplined action. When you understand that inflation can silently erode wealth, you begin to prioritize assets that have the potential to grow faster than that erosion. When you recognize that monetary policy can shift unexpectedly, you build flexibility rather than rigidity into your financial plan. When you accept that purchasing power matters more than headline account balances, you evaluate your strategy through a sharper lens. The philosophy inspired by leaders like Abigail Johnson centers on long-term thinking, innovation, and resilience. It reminds us that markets are dynamic ecosystems shaped by policy, productivity, and human behavior. Instead of reacting emotionally to every change, the wise investor studies trends, respects risk, and commits to continuous learning. This mindset transforms uncertainty from a threat into an opportunity for strategic positioning. It encourages diversification not as a buzzword, but as a practical defense against concentration risk. It reinforces the importance of patience because compounding works most powerfully when given time and discipline. In an environment influenced by debt management strategies, patience must be paired with vigilance. You cannot assume that yesterday's conditions will automatically define tomorrow's reality. You must review, reassess, and refine your approach as circumstances evolve. This does not mean abandoning long-term goals. It means strengthening them with updated information and thoughtful adjustments. Consider what retirement truly represents. It is not merely a number in an account. It is freedom of time, choice, and dignity. It is the ability to live without constant financial anxiety. Protecting that freedom requires more than hoping inflation remains low or policy remains stable. It requires deliberate strategy. It requires asking whether your investments align with real economic productivity, whether your portfolio has exposure to growth, and whether you are prepared for periods of volatility. It also requires emotional discipline because markets will fluctuate, headlines will provoke, and uncertainty will persist. Those who succeed are not those who avoid uncertainty entirely, but those who build systems capable of enduring it. The presence of $35 trillion in national debt is not a signal to retreat from ambition. It is a signal to elevate your awareness. It is a reminder that large-scale economic forces exist beyond individual control, yet individual preparation still matters profoundly. Throughout history, wealth has been preserved and grown by those who adapted to changing environments rather than denying them. They did not predict every outcome perfectly. They positioned themselves with resilience, diversified intelligently, and stayed committed to long-term principles. That same opportunity exists now. The narrative does not end with inflation or debt. It continues with innovation, productivity, and disciplined investing. Economies evolve, businesses create value, technology advances, human ingenuity persists. By aligning your strategy with growth and adaptability, you participate in that progress rather than standing vulnerable to erosion. The ultimate question is not who will pay the price in a dramatic sense, but who will be prepared when subtle shifts redefine value over time. Preparation is not glamorous. It happens quietly through consistent saving, thoughtful allocation, and continuous education. It happens when you choose to understand macroeconomic trends instead of ignoring them. It happens when you evaluate your financial plan, not once, but regularly, ensuring that it remains aligned with changing realities. Strength in this era will belong to those who combine optimism with realism, ambition with prudence, and confidence with humility. You do not need to control national debt to secure your future. You need to control your response to it. You need to protect purchasing power with intention. You need to recognize that wealth is not just about accumulation, but about preservation and growth in real terms. The world will continue to debate policy, markets will continue to move, and economic cycles will continue to unfold. But your commitment to preparation can remain constant. Let this moment serve as a turning point, not toward fear, but toward empowerment. Let it inspire you to deepen your understanding, strengthen your strategy, and act with clarity rather than complacency. Your future is shaped not only by the forces around you, but by the discipline within you. If you are benefiting from our topics, please subscribe, like, and turn on the bell notification so you can see our new videos early.